just over 400 investment trusts on the UK stock market. So investors wanting to put their money into this space, clearly spoilt for choice. The hard part is actually boiling them down to a much more manageable number, so you can then do some in-depth research yourself. So I'll talk through some ways that you can filter the market now. So stage one is kind of the basics. You need to define your personal situation. What's your investment goal, your time horizon, and your appetite for risk? You need to establish these parameters in order to work out which types of investments can actually help you achieve your goal. For example, you may wish to make a large purchase in 3 years' time. You have to think, well, firstly, is it worth investing in equities in the stock market and investment trust in such a short period? Imagine if the stock market fell during those 3 years. Have you really got enough time for the market to recover and the value of your portfolio to recover? But actually, if you've got a bit more time on your side, more than 3 years, you may be more comfortable investing in the stock market and may be more comfortable taking the high risks associated with this. But let's say you want to have a specific monetary target. Let's say you want to save up £50,000 over 10 years. You'd need to work out how much can you actually afford to put aside on a regular basis, and then work out what sort of level of return that you'd need to make every year in order to hit this goal. That can then help you work out which trusts might be suitable for you to take a further look into. For example, you can save £345 a month and achieve 4.5% annual growth, and that will hit £50,000 in 10 years. That's assuming 0.75% fees a year. But if you can only afford £300 a month, you'd actually have to take that annual return up to 7.5%. Now, clearly, that may lead you to want to look at more high-risk investment trusts or other investment types. The higher the risk, the greater potential for higher returns, but there's also the greater potential to lose money. So actually, if you're not comfortable with this, you need to think, well, perhaps I'm going to have to lower that £50,000 target, something more realistic, or I'm going to have to save for more than 10 years. Don't simply chase those high-risk investments just because you want to achieve that certain goal. So investment returns come in two forms. You either get capital gains, which is the growth in the value of your shares, or you get income from dividends. Now, the Association of Investment Trusts, also known as the AIC, they have a good filter on its website. That lets you screen the investment trust universe by growth and income, or just income. So an estimated 85% of investment trusts pay a dividend. Now, most will actually try to grow the value of the capital as well. You may take something like an infrastructure fund. You probably have lower capital growth with that compared to something like a smaller companies trust. But that's because the latter is probably considered to be a high-risk investment. But you have to remember that capital gains are not guaranteed, nor are dividends. Investments can go up and down in value. So there really is something for everyone in the investment trust space, meaning you can buy shares in a broad-based product, or you can actually have something a bit more niche. You can search by certain sectors, such as property or infrastructure. You can search by geographies, Europe, emerging markets, North America, for example, or you can search by investment trusts that may put their money into shares or bonds or debt or even a mixture of some of these. Now, some of these investment trusts position themselves as starting off in a very wide perspective, saying I can invest anywhere in the world, but I'm going to apply a certain filter. So it might be I'm going to look for high-quality companies, or I look for companies that are disrupting the market. Now, unfortunately, you need to manually look for these types of trusts because the types of filters you'll see from the likes of the AAC will only have those broad search criteria. So in terms of narrowing down this long list, you start off with just over 400. Let's try and get them down to a more manageable number. So at this point in the research, I normally like to look at the individual investment trust websites and look at financial websites like Morningstar. I think there should be 5 specific pieces of information you want to try and look for now. That's the investment process of the investment trust, the fund manager's track record, clarity of communication, discount or premium to net asset value, and past performance. Now, past performance, A lot of people say you should never judge your investment based on that, but I'll come and discuss that one in a minute. So the investment process is essentially what a fund manager wants to achieve and how they're going to go about doing so. Examples would include backing young companies which have the potential to be much bigger in the future and potentially disrupt traditional markets. It might be finding companies that try to generate high returns on the money that they reinvest in their business. Or it may be building a portfolio of companies tied to a thematic approach, such as trying to profit from an aging population. Now, a good investment trust should clearly display this on their website. I'll give you an example of Midwind International. Now, its strategy is clearly displayed on its website, saying to grow real wealth by investing in high-quality stocks worldwide. And it then goes on to provide 5 points that summarize its investment approach. It's got articles on there about the investment trust, the fund managers talking about portfolio decisions, and it really helps you get a feel of what's going on. And these are the sorts of things I think you should really demand for an investment trust if you really want to take them seriously. But in contrast, I came across rights and issues investment trust. Whilst the product maybe seemed quite interesting, I actually couldn't find a website for it. I found an investment trust service company, Maitland, had some information on its website, but it was just such limited information. I couldn't believe that they didn't want to let us, that the potentially future shareholders, want to know much more about this product. So I also think it's very important to work out when you're buying shares in investment trusts, are you actually paying more or less for the underlying assets? That's where you come into this concept of premium or discount to NAV. So the London Stock Exchange's website will publish the latest NAV figures. Some of them it does on a daily basis, some less frequently. So looking at Midwind again, for an example, so on the 8th of March, its shares were £4.89, but the NAV on that day was £4.75. So the NAV was lower than the share price. So if you'd bought that day, you would have paid a premium to own it. You would have paid 2.7% more for the assets than they're worth. But why do trusts trade above or below their value? So I'm just going to go through some examples now. So let's start with discount to NAV. This may happen if investors are scared. They may be wanting to dump their holdings in investment trusts. You have to think that trusts are probably less liquid than their underlying holdings in many situations. That should actually widen the discount if the share price is falling. Investment trusts may be, the investors may be skeptical about the stated NAV and think it's actually a bit less than what it is. Private equity trusts often trade at a discount because of this, because their valuations for their assets are often off market and not that frequent. Commercial property trusts is another good example. Investors may suspect that real world prices are actually a bit less than what the stated NAV is. And another example is just a lack of faith in the fund managers. In terms of trading on a premium, that can happen when investors are bullish. They may be wanting to put their money into an investment trust that's involved in a hot sector, or it may be the investment trust has had lots of publicity. Sometimes premiums occur when there's suspected undervaluation in the NAV. Or it may be that the NAV has risen beyond, they think the NAV has risen beyond its officially reported value. So Lindsell Train is probably a good example here. Now that's well known for trading on a premium. Currently it's 23% premium to NAV. Investors seem to believe that the trust's holding in Lindsell Train's management company is actually worth way more than is in its net asset value at the moment. A clue that this is the cause of the premium is the fact if you look at Finsbury Growth and Investment Trust, that's got the same fund manager, it's kind of got the same holdings, but it doesn't have that holding in the Lindsell Train management company. Actually, Finsbury trades pretty much around NAV. There's no premium there, certainly nothing like Lindsell Train. So other reasons might be, there could be strong faith in the manager's skill to generate true value in the future. But I think it's important, if you're going to buy investment trust trading a premium, just consider what happens if that premium narrows. Lindsell Train was on a 60% plus premium a couple of years ago. Now it's on 20%. Imagine if nothing happened to the NAV, that premium just decreasing. That would mean the value of your money is falling. So just things to consider. But actually, only buying trusts that trade on a discount and ignoring all the ones on premium may not actually be the best solution. you might actually miss out on trusts that have a really great track record. And equally, trust trading on a discount may not actually be the bargain that you think. You have to think, well, what's going to actually close that discount? It may not happen as quick as you think. So last weekend, I did some analysis, and I looked at the average discount or premium to net asset value over the last year, and then I compared it to what it's currently trading at. So here's a few examples. The BlackRock Commodities Income, that's averaged 3.4% discount to NAV over the last year, but it's currently trading on a 3% premium. Syncona, the healthcare-focused trust, now that's averaged a 20% premium over the last year, but it currently stands at 36.5% premium. And as for cheap ones, Polar Capital Global Healthcare, that's averaged 1.5% discount, and now it's on a 6.8% discount. I'm not trying to give you recommendations here to buy or sell certain trusts. I'm just trying to give you some examples. So back onto the past performance situation. I know we're all told past performance does not equal future performance. But actually, I think it's really important to understand why certain trusts may have underperformed the market. You should never just dismiss them, thinking that they're not very good. There may be times that the market is undergoing certain trends. It might be that the market is favouring momentum stocks, so value-focused investment trusts may be underperforming. But actually, you need to look at the fund manager's skill and just check whether actually they're adding value. You know, if a product is not adding value, fund manager is not creating true value, why should you invest in it? You might as well just buy a cheap tracker fund. Morningstar publishes annual returns data on its website, so you can actually compare the share price to the NAV and to the benchmark performance. Many investment trusts think that they've done a great job if they've beaten the benchmark. Just imagine if the stock market had fallen by 10% and an investment trust had fallen by 5%. Strictly speaking, the investment trust would have outperformed, but actually you would have lost money. Now, you may prefer to look at a fund manager and an investment trust. Really, strategy is to preserve capital, to avoid capital loss, and then try and generate positive absolute returns in the future. Rather than simply going for investment trust who thinks it's acceptable to say, I've beaten the market, that's what I'm meant to be doing, but actually I may have lost you some money. It's something to think about. So at this point in my research, I would normally now look for informed comments. This might be a research note or some comments from some experts. And actually, the general public's got some really great access to research stuff. I'll give you a list of a few of them. Kepler, you've got them, see them on the slide here. Kepler quoted data, Edison, Morningstar, all of these places, you can sign up and get access to research notes or comment. Hopefully, I don't think the access is, there's no charge. It should be free to access. So these some really good stuff on there. Shares Magazine, obviously, is another great source of information. We do an investment trust section once a week. Now, we regularly interview fund managers and look at broad investment trust spaces. Now, our comments are 100% independent, but it's worth stating that some of these people here produce research notes. They are paid by an investment trust to do it. But don't let that stop you reading them, because there's some really great information in them, even though you may think there is some bias because of their commercial relationship. So by this point, you should have slimmed down your list, hopefully, a lot more from the starting point. But there's just a couple more things to think about. Now, costs can vary widely across the investment arena. Now, you may think 0.5% or 1.5%, neither here nor there. But actually, costs can add up over time. They can really eat into your investment returns. So you should really look at the costs associated with a product. Another figure is to check is gearing. Now, this is the amount of debt compared to the equity for an investment trust. So fund managers can borrow money to potentially enhance their returns. It kind of creates a bigger pool from which to either earn more capital gains or increase the dividends. It's a really good way to enhance returns, but just remember that trusts with a lot of debt can actually underperform in a falling market due to the magnifying effects of gearing. Now, it's also quite a good thing that it gives investment trust fund managers the capability to potentially dip into some more money. If they haven't got any cash in their portfolio and they see some great opportunities, it means they don't have to sell anything. But of course, you have to remember there are downsides to it too. They have to be able to prove that what they're taking that extra money and investing it, that they get a better return on that than the actual cost of the borrowing. And finally, I think it's worth looking at the board of directors. They've got the power to sack a fund manager or change the investment mandate. The board challenges and they questions. They ask why a manager is doing what they're doing. Now, while the majority mandates don't really change, sustained periods of underperformance, issues at a managing company, or the departure of key staff are just some of the things which can actually trigger change in investment trusts. These highly skilled team obviously need paying, so that's an extra cost. But I think the costs probably the benefits outweigh the costs. If you think about it, boards have been widely credited for helping to keep fees much lower than the open-ended funds industry. And the board is the shareholders' voice, so they can take action to do stuff. And that particularly is not the case with many investment trusts and unit trusts and OICs. So in conclusion, finding the best investment trust does take a bit of work. But actually, I think the research process is really interesting. And I think if you can find some great ones that are really good at communicating what they're doing and really adding value, you just want to keep following these.